in the late 1990s as the world was changing. The internet had just started entering living rooms, and investors were convinced that the old economy of factories and retail stores was dead. A new era of e-commerce was born, and suddenly, every business with a .com at the end of its name was seen as a gold mine. The math was simple, or so everyone thought. Traditional metrics like price-to-earnings ratios, which measure how much you pay for a dollar of profit, were thrown out the window. Since these companies had no profits, investors started using new eyeball metrics. If millions of people visited your site, your company was worth billions. It didn't matter if you were losing money on every sale. Take the infamous example of pets.com. They spent massive amounts of money on Super Bowl commercials and branding to sell pet food online. The problem? Shipping heavy bags of dog food across the country cost more than the food itself. They were losing money on every single order, but their stock price still soared during their IPO. This was the era of the burn rate. It was a badge of honor for CEOs to spend millions on lavish offices, expensive parties, and aggressive marketing. The logic was that if you spent enough money to grab market share, you would eventually become a monopoly. It was a race to the bottom, funded by eager investors who feared missing out on the next Amazon. By early 2000, the Nasdaq Composite Index, which tracks tech-heavy stocks, had more than doubled in just a single year. It wasn't just professional investors involved, everyday people were quitting their jobs to day trade online. The belief was that the stock market would go up forever, and the internet would make traditional business rules obsolete. But reality began to set in. In March 2000, the bubble began to leak. Interest rates were rising, and several big tech companies reported earnings that were far worse than Wall Street expected. Suddenly, the eyeballs didn't seem to pay the bills anymore. Investors stopped asking about website traffic and started asking a dangerous question: where is the actual cash? Panic set in almost overnight. As stock prices dropped, companies that were burning through cash couldn't raise more money. Without new investment to keep the lights on, they simply ran out of money. Within months, hundreds of .com companies evaporated. Offices were cleared out, and high-tech servers were sold for pennies on the dollar at liquidations. The crash was brutal. From its peak in March 2000 to its bottom in October 2002, the Nasdaq lost nearly 80% of its value. Trillions of dollars in paper wealth disappeared. For the people who had invested their savings into these get-rich-quick internet stocks, the dream of a new digital economy had become a financial nightmare. Yet, not everything died. While many companies were just hype, the internet itself was real. Survivors like Amazon and eBay spent the years following the crash refining their business models, focusing on efficiency and actually making a profit. They became the giants we know today, built on the ashes of the companies that failed to adapt. The dot-com crash teaches us that no matter how revolutionary a new technology might be, the fundamental rules of business never change. A company must eventually generate more cash than it spends. Innovation is important, but a sustainable business model is the only thing that survives when the hype dies down.